traders move into the Forex market, believing that it is a much simpler market to trade, not least because there are relatively few instruments. At best, the choice is between the 6 major pairs and some of the more liquid crosses. Unlike the equity market, where traders and investors are faced with literally thousands of stocks to choose from, hundreds of exchange-traded funds and many indices, as well as a myriad of trading strategies. It's no wonder, therefore, that so many are tempted to try. This belief is then further compounded by much of the marketing aimed at traders, which also stresses this simplicity and other benefits, such as the Forex market's deep liquidity, continuous trading hours, and of course the stupendous returns. The reality is, of course, that most Forex traders lose, and lose not only once but multiple times before giving up, having exhausted not only their trading capital but also damaged their self-esteem and belief in themselves. But it doesn't have to be this way. Once Forex traders begin to understand the structure and dynamics of the market, and that far from being an easy market, the Forex market is probably the most complex of all the capital markets, as it is driven not only by economic and fundamental news, but also by related markets, politics and events, both real and manufactured. In fact, the price action of all the currency pairs is a visual representation of this confluence, and the good news is that this complexity does not necessarily mean complicated. In fact, once traders begin to identify the primary drivers of the Forex market and their impact on individual pairs, confidence and capital can be restored. For this video, I'd like to introduce one of the drivers all Forex traders should understand and follow, and would like to start with commodities, and in particular the US dollar-gold relationship. Most Forex traders will be aware that commodities are priced in US dollars, and as such, any move in the US dollar will impact the broader commodity market. The relationship is generally inverse. In other words, when the US dollar strengthens, commodity prices tend to fall, but when the US dollar weakens, commodity prices rise. However, whilst this relationship is fairly straightforward, there is one major exception to this general rule, and that is with the US dollar and gold. The relationship between gold and the US dollar is both close and sensitive, and like most other commodities, generally inverse. But there have been occasions where there has been a positive correlation, with both either falling or rising in tandem, before reverting to their more usual inverse state. One period when we saw gold rising, along with the US dollar, was from February to June 2010, followed by 2 months when both gold and the dollar fell, before finally in August the inverse relationship was re-established once again, with gold moving higher and the US dollar continuing to move lower. But what are we to make of all this? Well, let me try to explain. Early in 2010, the sovereign debt issues in Europe began to surface, especially from countries such as Ireland, Portugal and Greece, suggesting they were in severe financial difficulties and in danger of default without help from the ECB. This is something the Euro project could not and would not tolerate. Does this sound familiar? The markets reacted by selling the euro and buying the US dollar. But many also decided to put their faith in the ultimate safe haven for money in times of economic uncertainty or turmoil in the markets, in other words, gold. In fact, we could say that since the start of the present financial crisis, the dilemma has been between faith in paper-based assets or faith in tangibles such as gold. The debt problems in the Eurozone are, of course, still ongoing, and it will be interesting to see whether this is reflected once again in the gold-dollar relationship, and whether we will see a repeat of the 2010 chart pattern. Today is Thursday, the 21st of July 2011, and is the day when EU heads of state are supposed to be trying to resolve, once and for all, the Greek debt problems. And at the time of this recording, the euro has been rising against the US dollar, while gold is once again at $1,600 per ounce. In other words, the inverse relationship between gold and the US dollar appears to be holding. Whether it will continue to hold over the next few weeks and months remains to be seen.